confirm the LC, give an additional undertaking in another country. So importer have already applied for letter of credit and given the money to the importer's bank. By the time the importer's bank is telling the confirming bank to confirm, he will release the money and release the LC. By then, confirming bank holds the money, send the LC to the exporter's bank, exporter's bank receive the LC, release the goods. After shipping the goods, present document to his bank. Look at this. After he present document to his bank, confirming bank will pay him. So whatever happened to this buyer and his bank is none of my business, because there is a bank outside the country who is going to pay. As soon as I receive my money, by the time I receive my money, document is just getting to the importer's bank, and then the importer have the document, and then the importer can go and clear his goods. Then we have advance payment. Of course, this is a very simple process. I receive money first, I ship the goods, I present document, and then afterward I get my payment. Look at the order of risk. Open account for an exporter. This is an exporter. Higher risk, open account, followed by B for collection aside, followed by B for collection tenor, followed by side collection, followed by unconfirmed letter of credit, confirmed letter of credit, and then cash in advance. Export trade finance checklist. You are an exporter. You are going to your bank for money. There are some things the bank want to know, and it's good you are aware of these things, so that by the time you are getting to the bank, you have answered their question even before they ask the question. What are the things the bank wants to know? First of all, you need to know the fact that if you are looking for finance, it can be pre-shipment or post-shipment. Pre-shipment means the money I need to buy product and ship. Post-shipment means I've shipped already, I need to do the second tranche of shipment. On the strength of the first tranche money I'm expecting, I'm getting money for the next shipment. I can source my fund from personal savings, existing business, loans from banks. So if you're going to bank to source for loan, the banks want to know your history. 10 export financing checklist. 10 export financing checklist. Here we've talked about the export financing checklist, and the whole idea of this checklist is that for you as an exporter, number one, for a banker, if you want to finance an export transaction, especially from Nigeria, you need to have this handy. So that the question you should ask from your customer before, by the time it's coming to you, as an exporter also, you should be able to master this, ensure you have all this handy, so that you already answer the question before the banker asks you the question. Number one, history of bill of lading. History of performance through bill of lading. The bank wants to know, have you done it before? Have you exported before? If you have not done it before, the risk is higher for them. They might not be interested in financing you. But if you have done it before, they will now ask you, show us your invoice. Invoice a fraudulent exporter can go and prepare invoice. Show us your bill of lading. Bill of lading can easily be verified from shipping line. So with bill of lading, they know you have shipped. The bill of lading shows the volume of export by container. The invoice shows the volume of export by figure. Figure, I mean the dollar value, euro value, or pound value. So the bank wants to know the export volume per annum. How much do you ship per annum? What's the volume of what you export per annum? Then they want to know frequency of export. How often do you export? Every month, every week? Your bill of lading record will also show that. Then payment method. Every bank wants letter of credit. Some bank can do before collection aside if you have other collateral. If you are doing equity contribution, they can afford to do before collection aside. In fact, if you can get the buyer's bank to avalize the bill of exchange, which I will be explaining that terms later on, then they can afford also to accept that. Payment method, that will be stated on the export contract. Terms of payment, how are they paying you? The initial amount they are paying, does it cover the cost? Does it cover what the bank is financing, so that the bank will be comfortable that at least the money will come back on time before they are expecting their interest? Terms of payment of the export contract, very, very important for the bank. Then, product sourcing option and strategy and risk mitigant. Product sourcing option, strategy and risk mitigant. The question you want to ask yourself is, the question the bank wants to know is, how are you sourcing for product? How? Are you giving the money to your bank and to the buyer, and you just release the money to them like that? By the time you release the money to them like that, that means that if the person decides to go and marry the second wife, then the bank will now start chasing the exporter up and down. So the bank will want to know, are you giving the money directly? If you are giving the money directly, which is something you can do, how about covering that risk? Is it giving you an advance payment guarantee? or performance bond, the bank wants to know, how do you want to buy this product? Seasonality and availability of product, very key. Very, very key. How seasonal is the product? How available is the product? So that they will know, if you are getting a contract for 1 year, they want to know, for how long are we going to finance this thing? Then transaction cycle, from commencement to the payment of proceed. From the time you sign contract to when you get paid, what's the cycle like? The bank wants to know. That also helps them in taking financing decision. Lastly, they want to check your account, either with them or with other banks. Has this person paid you before? What is his payment history? If he has paid you before, let's see from your record on your account. The bank wants to know that also. So these 10 export financing checklist is very, very important for both bankers that want to finance export and for both the exporter who want the bank to finance. We're moving on to the next aspect in the video presentation: export trade finance options. The trade finance arena creates a great variety of opportunity for financing across the lifespan of a transaction. Funds can be borrowed from financial institutions, or deals can be structured in such a way that one party is in effect financing the other through the terms of their contract. Trade finance instruments are often very flexible and versatile. Sometimes specific product, service, or instrument or variation or existing one are created to meet the needs of a particular industry, regions, or circumstances. So you can be very dynamic in financing trade. If you are financing a trade transaction, if someone is beginning a machinery, he wants to export, but beginning a machinery, it's an exporter. But he's beginning a machinery to process. This person has history of exporting before, but he processes this product through another person. But now he wants to begin to still do the same export. But he's beginning machinery. The bank can easily finance the machinery because he has an export order. And since he's a performer in the past, they will do lease financing for him. They give him the product on lease. So he brings in the product still owned by the bank, and then he has order to get product, process the product now by himself. Now he's making more profit because he's incurring less cost of processing, and then ship the goods out. As the money is coming in, the bank is taking their own cut. The money goods coming in, the bank is taking their own cut. Before you know it, he has finished paying for the machine is at ease now. Then he can continue the business. So the different way you can structure this loan for exporters. So it's very dynamic. And it's good the account officer, the banker, understand how to structure this financing to be able to meet the exporter's demand and of course make money for the bank. So export finance instrument, you can use factoring, you can use invoice discounting, you can use forfeiting, you can use export credit insurance and the like. Now let's look at factoring. For every banker listening to this DVD, watching this DVD at this point, I want to appeal to you. If you can just try to read more about this after you have listened to this DVD and see how you can come up with this product. If you can come up with this finance product, you make a lot of money from exporters in Nigeria. They need factoring to be able to improve their cash flow. But a lot of bankers don't even understand what factoring is all about, which is not a sin.